Welcome, everyone. If you've been watching the software sector this year, there is literally one massive debate dominating the conversation. Is artificial intelligence going to wipe out incumbent software giants, or is it going to make them more profitable than ever? Well, let's figure this out together by looking at what might be the absolute ultimate test case today. Okay, let's dive into this explainer on Adobe's Q2 2026 pre-earnings setup. We're going to break down the hard data, the market sentiment, and the specific metrics that will determine if this creative juggernaut is an AI victim or an AI victor.
To really understand the stakes here, we absolutely have to start with this number, 30%. As of early June 2026, Adobe stock is down roughly 30% year-to-date. This isn't just some minor market correction. We're talking about a massive structural re-rating by the market that has left a lot of seasoned investors completely scratching their heads.
And honestly, that leads us to the central mystery of this explainer. Why on earth is a company with over 850 million monthly users, record operating cash flow, and an incredible 13-quarter revenue beat streak seeing its stock just plummet? Usually consistency like that is rewarded with a premium valuation, right? But Adobe has been severely punished.
So, here's how we're going to unpack this whole thing. First, we'll look at the Adobe paradox. Then, by the financial numbers. Third, the AI disruption threat, followed closely by Adobe's AI counteroffensive. And finally, what analysts are watching.
All right, part one, the Adobe paradox.
There is a massive tug-of-war happening right now. On the bull side, you've got a company that has beaten Wall Street's revenue expectations for more than 3 years straight. Actually, in their last reported quarter, Q1, they delivered $6.4 billion in revenue. That's up 12% year over year. But on the bear side, the stock is currently trading near levels we literally haven't seen since around 2019. The market is effectively saying, hey, the past 3 years of growth don't matter because your future is fundamentally broken.
But not everyone agrees the sky is falling. The noted investor Michael Burry recently weighed in on this exact setup. He pointed out that Adobe, especially with its new management structure, is sitting on an absolute treasure trove of assets that can be used to train AI models better than almost anyone else out there. As he puts it, even if this is partially true, the market is underpricing the stock by quite a bit. Price matters. It's a great reminder that at a certain point, a massive sell-off actually creates a deep value opportunity, assuming the core business remains intact.
Moving to part two, by the financial numbers.
Now, what's really interesting here is Adobe's actual income statement from Q1 2026. If we look down near the bottom line, they generated an astounding $1.889 billion in net income. And that's just for a 3-month period. That's built on nearly $6.4 billion in total revenue. So to put that into perspective, we're talking about a net margin of around 30%. Guys, this isn't some struggling, cash-burning startup. This is a highly optimized, incredibly profitable software machine.
And that massive profitability translates directly over to the cash flow statement. In that very same quarter, they generated almost $3 billion in net cash from operating activities. But the real kicker is in the financing section. Adobe aggressively spent $2.478 billion buying back their own common stock right in the open market. Basically, when management sees the stock down 30%, they're using their huge pile of cash to buy the dip themselves.
In fact, Adobe's board has granted authority for a staggering $25 billion stock repurchase program. Think of this as a powerful mechanical cushion right under the stock. If there's any post-earnings weakness, Adobe literally has the authorized capital to step in and buy. That provides a structural floor that a lot of high-growth tech stocks simply do not have.
All right, part three, the AI disruption threat.
So this fear didn't just happen overnight. It really evolved over a few crucial months. Back in early 2025, analysts loved Adobe. They were giving it a mean price target of $565. But then, the narrative shifted. Fast forward to April 2026, and Anthropic launches Claude Design. Investors immediately read this as a direct automation threat to Adobe's core tools. Right after that, we saw weak earnings from software peers like IBM and ServiceNow, which triggered a sector-wide software derating. It just spread like wildfire. By June 2026, the street's mean price target had completely collapsed by 42%, down to about $327. Basically, analysts are pricing in a future where AI completely eats Adobe's lunch.
Heading into the Q2 earnings call, this creates what analysts are calling the panic scenario. And let me be clear about this. Merely beating standard EPS estimates? That's table stakes at this point. They've done that 8 quarters in a row. So what would actually trigger another sell-off? Well, primarily three things. First, a second consecutive mess on net new annualized recurring revenue. Second, if management gets on the call and only talks about AI usage stats instead of actual dollars being generated. And third, any reduction whatsoever to their full-year guidance. If any of these happen, the AI victim narrative completely wins.
Let's move to part 4, Adobe's AI counteroffensive, and see how this builds.
Because while the market is panicking, Adobe's internal metrics are telling a totally different story. In Q1, their AI-first annualized recurring revenue literally tripled year over year. Tripled. Their Firefly Enterprise platform saw new customer acquisition grow by 50%. And this isn't just theoretical fluff. They're signing massive real-world deals, like a really cool strategic partnership with Dick's Sporting Goods to use Adobe's AI solutions to create personalized digital coaches for athletes. So they're proving that enterprise brands actually want AI safely integrated into their existing Adobe workflows, rather than scattered across a bunch of unproven startups.
To prove they're winning, Adobe absolutely needs to deliver what's called the calm scenario in Q2. Investors want cold, hard proof that AI is feeding their creative software business, not eating it. What does that mean? It means showing that AI-first ARR is accelerating, pushing net new digital media ARR back up above the critical $450 million mark, and ideally, management raising their full-year guidance to show absolute confidence in their pipeline.
Which brings us to part 5, what analysts are watching. First up, the baseline expectations. The consensus estimate for Q2 revenue is $6.45 billion. Hitting that is going to require roughly 10% year-over-year growth. Down on the bottom line, expectations are clustered around $5.81 to $5.82 in earnings per share, which represents a really solid 15% growth from the year-ago quarter. Now, while these estimates have drifted down slightly in recent weeks, they still demand highly respectable double-digit performance.
On the technical side of things, the chart definitely has some heavy damage to repair. The stock remains in a pretty clear longer-term downtrend. Traders are closely watching $259 as a critical resistance ceiling. That's roughly where the 100-day simple moving average sits, and rebounds are very likely to stall out there unless we get a massive beat. On the downside, $224 is the key support floor, sitting right on the 52-week low. A break below that could signal a much deeper capitulation.
So the crucial point is this. Thursday, June 11th, 2026, after the market closes, isn't just an earnings print for one single company. The entire software sector is basically holding its breath right now. Adobe's results are going to set the tone for exactly how Wall Street values legacy tech companies navigating this massive AI transition.
And it all comes down to this final question. Will Q2 prove that Adobe's 850 million users and record cash flows are just a relic of the past, officially making them an AI victim? Or will their aggressive buybacks and surging Firefly enterprise growth prove they are an AI winner, ready to absolutely dominate the next decade? Watch the print, keep a close eye on that ARR data, and we will see which narrative ultimately wins out. Thanks so much for joining me for this explainer. Keep learning, and I'll see you next time.